In this video, we're going to be performing a deep dive on California Water Services Dividend Safety. To begin, let's talk about California Water Services' business model. California Water Service was founded in 1926 and has grown into the third largest publicly owned water utility in the U.S. With a market capitalization of $2.6 billion. It has 6 subsidiaries which provide water to about 2 million people in California, Washington, New Mexico, and Hawaii. California Water Service is a well-known dividend stock because of its compelling track record of dividend growth, with 51 years of consecutive dividend increases. California Water Service is a member of the Dividend Aristocrats Index, a group of elite dividend stocks with more than 25 years of consecutive dividend increases. In fact, California Water Service's dividend history satisfies the requirement to be a dividend aristocrat more than twice over, with more than 5 decades of consecutive dividend increases. California Water Service is a member of the Dividend Kings, a group of even more exclusive stocks with 50-plus years of dividend increases. Looking ahead, investors cannot rely on California Water Service's dividend history alone as a measure of its dividend safety. For the remainder of this video, we will discuss the company's current dividend safety from 4 perspectives. 1. Its dividend safety in the context of its current earnings. 2. Its dividend safety in the context of its current free cash flow. 3. Its dividend safety in the context of its recession performance. 4. Its dividend safety in the context of its current debt load. First, let's discuss California Water Service's dividend safety in the context of the company's current earnings. When California Water Service announced its fourth quarter financial results on February 28th, the company reported that it generated earnings per share of $1.36 during the fiscal year. For context, California Water Service paid 75 cents of common share dividends during the same time period, for a dividend payout ratio of 55%. Using earnings, California Water Service's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. Accordingly, we will now compare California Water Service's current dividend payment to its free cash flow. During fiscal 2018, California Water Service generated $179 million of cash from operating activities and spent $272 million on capital expenditures, for free cash flow of a negative $93 million. As a result, free cash flow did not cover the company's common share dividend payments of $36 million. Using free cash flow, our conclusion is that the company's dividend does not appear safe for the foreseeable future. However, it is important to bear in mind that some of the heavy capital expenditures were due to investments in business development and irregular repair expenses. As a result, the dividend should be covered by free cash flow moving forward. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. Accordingly, this section will analyze California Water Service's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. California Water Service's performance during this time period is shown here. California Water Service's earnings per share actually continued to grow during the last recession. More importantly, the company's earnings continued to cover its dividend, and it continued its multi-decade streak of consecutive dividend increases. Accordingly, we have no concerns about the company's ability to pay rising dividends during future economic downturns. The last angle that we will use to assess California Water Service's current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before the company's free cash flow will no longer cover its dividend payment. During fiscal 2018, California Water Service generated $36 million of interest expense and had $880 million of debt outstanding for a weighted average interest rate of 4.1%. The following image shows how changes to California Water Service's weighted average interest rate would impact the company's dividend coverage as measured by free cash flow. As the image shows, California Water Service is already free cash flow negative even before interest. However, as the weighted average interest rate increases, it puts considerable pressure on cash flows. Every 100 basis point increase in interest rates reduces current operating cash flows by 5%. Accordingly, we believe that California Water Service's debt level is likely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on California Water Service's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.